The United States Treasury market, the world's largest and most liquid government securities market, is significantly influenced by the actions and policies of three major players: China, Japan, and the Federal Reserve. These entities, through their substantial holdings, purchasing patterns, and monetary policies, wield considerable power in shaping the dynamics of the US Treasury market, affecting interest rates, bond yields, and overall economic conditions. China's role in the US Treasury market has been a topic of intense scrutiny and debate for years. As of March 2024, China held approximately $767.4 billion in US Treasuries, accounting for 10% of the US national debt. This substantial investment serves multiple purposes for China, including maintaining lower export prices and securing its foreign exchange reserves in safe assets. The Treasury Undersecretary for International Affairs recently highlighted the challenges posed by China's economic strategies, stating, "We will take defensive action if needed, but we would prefer for China to take action itself to address the macroeconomic and structural forces driving overcapacity." China's economic focus on export-led growth has led to a significant trade surplus with the United States, resulting in Chinese exporters accumulating large amounts of US dollars. The People's Bank of China, PBOC, intervenes in currency markets to balance exchange rates between the US dollar and the yuan, leading to the accumulation of US dollars as foreign exchange reserves. This strategy, while crucial for China's economic stability, can result in challenges such as inflation, which requires careful management through state control measures. The interdependency between China's purchase of US debt and the US trade deficit underscores the significance of US Treasuries as a preferred option for China. However, concerns persist about the potential risks involved for both nations. Some analysts worry about the possibility of China selling off these treasuries as a form of retaliation, which could potentially lead to higher interest rates and negatively impact economic growth. Despite these concerns, the likelihood of China engaging in a massive sell-off remains low due to the complex repercussions involved. Japan, another major player in the US Treasury market, has recently increased its holdings, becoming the largest foreign holder of US Treasuries. This shift comes at a time when China has been reducing its investments in US bonds amid escalating trade tensions. The actions of these two Asian economic powerhouses have significant implications for the US Treasury market and the dollar's status as the dominant global reserve currency. Jamie McGeever, a seasoned financial journalist, notes, "As the trade war between the United States and China escalates, China is shrinking its holdings of US bonds. This trend, coupled with Japan's increased investments, highlights the shifting dynamics in the global financial landscape and the potential challenges to the dollar's supremacy. The Federal Reserve, as the central bank of the United States, plays a crucial role in shaping the Treasury market through its monetary policy decisions and large-scale asset purchases. In response to the COVID-19 pandemic, the Fed implemented quantitative easing (QE) measures, significantly expanding its securities portfolio from less than $4 trillion to $8.5 trillion between March 2020 and March 2022. The Fed's actions have far-reaching consequences for the Treasury market. As explained by the Brookings Institution, in the course of making monetary policy and issuing currency, the Federal Reserve accumulates a portfolio of Treasury and agency securities, which earn interest. The interplay between the Fed's asset purchases, interest rates, and remittances to the Treasury has significant implications for monetary policy and the broader economy. The Fed's ability to influence the Treasury market extends beyond direct purchases. Through open market operations, OMO, the Fed can increase or decrease the total supply of money and impact interest rates. As noted by Investopedia, OMO can increase or decrease the total supply of money and also influence interest rates by changing bond prices. This tool allows the Fed to fine-tune its approach to monetary policy and respond to changing economic conditions. The relationship between these three major players, China, Japan, and the Fed, creates a complex web of interactions that shape the US Treasury market. Their decisions and actions can have profound effects on interest rates, bond yields and overall market stability. For instance, if China were to significantly reduce its treasury holdings, it could potentially lead to higher interest rates and increased borrowing costs for the US government and consumers alike. However, it's important to note that the interdependence between these entities also serves as a stabilizing force. As Treasury Secretary Janet Yellen stated, "A growing China that plays by international rules is good for the United States and the world. Both countries can benefit from healthy competition." This sentiment underscores the mutual benefits of maintaining a stable and functioning treasury market. The impact of these players extends beyond the treasury market itself, influencing broader economic indicators and policy decisions. For example, the Fed's quantitative easing measures have implications for inflation, employment, and overall economic growth. As explained by the Brookings Institution, the easier financial conditions caused by the QE help boost output and employment. Indeed, that is the point of conducting QE when the Fed's short-term policy rate is constrained by its lower bound. The actions of China and Japan in the treasury market also have geopolitical implications. Their holdings of US debt can be seen as a form of economic leverage, potentially influencing diplomatic relations and trade negotiations. The recent shifts in China's treasury holdings amid trade tensions highlight this dynamic. Looking ahead, the future of the US Treasury market will likely be shaped by evolving economic conditions, geopolitical developments, and policy decisions from these key players. The ongoing challenges posed by China's industrial overcapacity, as highlighted by US Treasury officials, may lead to new approaches in addressing trade imbalances and their impact on the treasury market. Japan's increased role as the largest foreign holder of US Treasuries bears watching, particularly as it navigates its own economic challenges and monetary policy decisions. The Bank of Japan's policies and their potential impact on the yen could have ripple effects on the treasury market and global currency dynamics. For the Federal Reserve, the challenge lies in balancing its dual mandate of maximum employment and price stability while managing its substantial treasury holdings. As interest rates rise, the Fed may face periods of reduced remittances to the Treasury or even temporary losses. However, as noted by the Brookings Institution, even if QE leads to Fed losses in some periods, it will likely also boost Fed profits in other periods. In conclusion, the US Treasury market stands at the intersection of global economic forces, with China, Japan, and the Federal Reserve playing pivotal roles in its functioning and stability. Their actions and policies create a complex ecosystem that influences not only bond yields and interest rates, but also broader economic indicators and geopolitical relationships. As Treasury Secretary Yellen aptly stated, the United States believes that responsible economic relations between the US and China is in the self-interest of our peoples. It is the hope and expectation of the world. This sentiment can be extended to include Japan and the Federal Reserve, emphasizing the importance of cooperation and mutual understanding in maintaining a stable and efficient treasury market. The future of the US Treasury market will undoubtedly be shaped by the ongoing interactions between these key players, as well as emerging economic challenges and opportunities. As global economic dynamics continue to evolve, the Treasury market will remain a critical barometer of financial health and a key instrument in shaping monetary policy and economic growth. Understanding the intricate relationships between China, Japan, the Federal Reserve, and the US Treasury market will be essential for policymakers, investors, and economists alike as they navigate the complex landscape of global finance in the years to come. Thanks for watching this exploration of the complex world of the US Treasury market. If you found this information valuable, please hit that like button and subscribe to our channel for more in-depth economic analyses. Want to learn more about global finance and its impact on your daily life? Don't forget to ring the notification bell to stay updated on our latest videos. Have questions or thoughts about the US Treasury market? Leave a comment below. We'd love to hear from you and may address your questions in a future video. Until next time, keep expanding your financial knowledge.